Look at this. This is our debt. I don't know if you guys knew that there's a ticker online that tells you what our national debt is. And look at it, just keeps compiling and going higher and higher and higher. And now we're sending monies off to everybody in the world. We're giving student loan deferments or forgiveness and all this other stuff. Guys, we can't solve all the world's problems by just cutting a check. I'm going to leave it at that. So in today's agenda, what we're going to talk about is the debt ceiling, all the ramifications if they don't pass a new debt ceiling, which they will. And then we're going to go through the rest of the topics that we talk about on a daily basis. So what I want to show you guys is this is the national debt that we have. And it keeps growing and growing and growing. Some of the concerns here is that you see, if you really break these numbers down, it gives you a lot of details here that you don't even really realize. You can look at this thing and say, oh, that's a pretty wild ticker and there's all kind of numbers here. But if you really dig into it, I encourage you guys to do this. It goes down through and it tells you everything about unfunded debt, down through here, student loan debt. Did you know there's, I don't even know what this number is. Is it a trillion or gazillion or bagazillion or something like that? So look at this thing, just keep going up and up and up. That's the problem, folks. That's the problem. It's not the forgiveness. I think the colleges are doing our students a disservice. They're charging way too much money, and we as parents and students, we need to make prudent decisions when it comes to this. So without further ado, let's get over to our agenda today. But the main topic was the debt ceiling. So what in the world is the debt ceiling? So the debt ceiling is the maximum amount of money that the U.S. government can borrow cumulatively by issuing bonds. The debt ceiling was created under the Second Liberty Bond Act of 1970. 17 is also known as the debt limit or statutory debt limit. So, do they really go by this stuff? No. Because our government has never failed to pay one of their bills. So that means basically they're going to pay everything. What happens most of the time is there's a whole big dilemma about all this stuff, and the government, they'll shut down and people won't be able to go to work and everything. But then after 2-3 weeks, everybody will get their back pays back and everything else, and they'll get bonuses and stuff like that, because it's like, oh, sorry, you didn't get a paycheck for 2 weeks and things like that. And I know I'm being a little sarcastic, but guys, this is over and over. It's like insanity. You repeat something over and over and over, expecting changes, but you're not doing anything to make changes. Okay, so that's my kind of rant of the day. The debt ceiling, they keep talking about it all over media and everything else. Guys, look at it. The numbers are insane. So at some point, they got to do something. We're the only developed country with a balanced budget. And that's obscene. I had a whole bunch of other content that I was going to show you guys today, and I'm like, you know what? Why even bother? Because you and I aren't going to affect this thing, and that's pretty much a shitty way to look at it. But this debt is running out of control, and instead of trying to fix a lot of these issues, what they just do is they keep throwing more and more money at it, and that's completely the wrong thing to do. So this isn't going to affect housing. This isn't going to affect interest rate. This isn't going to do anything other than it's going to be a part of our mainstream media for the next 2-3 weeks or whatever until they resolve this thing. And they will. I promise you they will. They always do. So with further ado, let's just skip on and go to the next thing. So what are we seeing in the markets right now? Well, we had some economic data comes in. Let's go over to see that right now. Here's the dismal numbers that we want to see. So the first thing I saw today is the initial jobless claims. So here's what we're looking at. The Federal Reserve says, okay, we're going to inflict pain on everybody out there. So they've already inflicted pain on the housing business. That's already a done deal. Now they want to inflict pain on the jobs market, because their expectations are if more and more people lose their jobs, well, they can't buy stuff, so thus inflation is going to come down. That's their thinking, okay? So the report that came out today, the initial jobless claims, it was actually came in a little bit higher than expected, and that's a good thing. But the markets are basically railing off of this thing. So the previous reading, there was 240,000 people that filed first claims for unemployment. The expectations were to stay steady. Well, actually it raised a little bit. So that's actually what the Federal Reserve wanted. But the markets are now saying, oh, we don't want this. So the markets are countering that. And I'm going to show you that in a second. But the dismal information is right here. The Philly Fed Manufacturing Index. What this measures is how much activity is in the manufacturing sector. And in this case, it is for the Philadelphia area. But this represents a huge portion of our country. You can see down here, here. If the number is positive, well, that's good. If the number is negative, that's bad. And the bigger the negative, the bigger the bad. Okay, so the previously reading, we were minus 23 on manufacturing. So just think of it, production is down 23. And it's not 23%, but the number's just down 23. The forecast was to increase or go up to minus 19. Okay, it went down considerably. It went down to 31. So what if we tie all this together? I got a little illustration here, and this is kind of a corny illustration, but let's go through it. When you're looking at a product, so you and I are the consumers. We're the customer right here. We end up buying the final product. But look at the stages of that product in development. So you come up with an idea, then you do research, and then you do all these other things, and then you get down through here. A lot of people just disregard all this. Then you get to the production part. Look, you have manufacturing, machinery, raw materials, everything else. So if this section right here is really starting to cut back, well, it's going to cut back all through here. What is that? Manufacturing, run by people. Machines, run by people. You know, all this other stuff. How do they produce this stuff? By people. So if production is going way down, like we're seeing right here, what's the next thing to kind of hit? What's the next thing, you know, the crap to hit the fan is basically in your production part, because now the delivery to the customer isn't as much needed because people are pulling back because people are getting unemployed, and it's a snowball effect. So you're not buying as much stuff because you're not making as much money or you're laid off. So then you start spending less. So then on this side of the equation, they don't have to manufacture as much. So they don't need as much as many people, as much raw materials, as much energy and everything else. So now the economy is going to contract substantially. This number was kind of a shocker. Trust me, this is a pretty bad number. So it's saying the manufacturing sector is getting really, really bad. So let's get over to how all this is affecting the markets right now. You can't see when these numbers are good, but right now we have the MBS market up 14 on the 6 coupon and up. It can't be 120. It's up 20 on the 5.0 MBSs, and the 10-year Treasury is really not doing anything. It's basically down 0.05. So scratch that. And then on the mortgage front, we might see rates come down just maybe 0.05, which you won't even see that on rate sheets because we don't go in increments of 0.05. So we're probably not going to see really anything in regards to this for today. One piece of the puzzle I want to show you guys here is Zillow came out with some research, and you guys take it for what it's worth. It's coming from Zillow, but they're saying if you're in moderately priced homes, and that's $250,000 and less, you're going to face a bidding war continuing through 2023. So here's my dilemma. If we're experiencing or we're expecting a housing drop, well, in what sector is it going to be? Because 300,000 and below is going to see, as Zillow's saying, and we're seeing it on our end as well, bidding wars. So it's putting people in that sweet spot. It's the same as they're paying in rent, but now they can own their own home. So that's the conundrum that we have is bidding wars mean there's not going to be a reduction in prices. So there's going to be some areas that, you know, especially middle income homes, those areas are going to fare very well. You're going to have areas that just ran out of control for 2-3 years. Those are going to contract substantially. And we have the upper class of homes, you know, maybe 700,000 to a million plus. Those are going to see a lot of dismal numbers probably in the next 6 to 8 months that you're seeing there. So let's check over to the excuse me, I'm sorry about that, Chicago Mercantile Exchange, to see if there's any change in what they're expecting from the Federal Reserve. And no, here's what they're expecting from the Federal Reserve. So if you don't watch my videos on a daily basis, we usually check out the Chicago Board of the Chicago bond market, futures market. Whew, I got a brain freeze there. And we look at this to figure out what the Federal Reserve is going to do at their next meeting or next meetings. And here's the meeting's probability. Right now, the federal funds rate is 4.75 to 5. So we're in this range right here. Okay, so what we're trying to figure out is what the Federal Reserve is going to do at the next meeting, maybe the next couple meetings. So we're seeing in May, they're expected to move it from 4.75 to 5.25. So that means it's a 0.25% increase in the federal funds rate. And those probabilities are right through here. So you're seeing that the probability in the next meeting is they're most likely going to do it. And then from there, it's going to stay steady. And even one of the Federal Reserve people that sit on has a spot at the Federal Reserve said yesterday, we probably got one more and done. So they're expecting one more rate increase, and then you can see how this starts to trickle backwards. So they're expecting from there, the Federal Reserve is going to pivot and start reducing interest rates. So let's see where rates are, or where they ended last night. So they ended last night up 0.05. Hey, I remember I said right here, with the market's going right now, right here, I expect the rates to come down 0.05. So basically, we'll be back to where we started yesterday morning. So these are the top 6 products people use when they're buying or refinancing a home. And these are issued by Mortgage News Daily on a daily basis. If you want this report, I have it right down below in the description where you can sign up for this. But if you want this, and you want information like this and breaking news like this and so much more, subscribe to my newsletter down there. I don't use it to sell. I don't sell your data for sure. And I usually don't even use it to solicit you. I might put you in a database that you get my newsletter, a separate newsletter, but trust me, you're not going to get bombarded with stuff, and I'm not going to sell your data. So that's it for today, guys. I hope you found some value in this. If you did, all I ask you to do is give me a thumbs up, subscribe down below, and hit the bell every time I post a video. You get an alert. God bless, guys. I'll see you later today. Bye-bye.